Have you heard the news? The gold price has just soared past $2,000. But where is it headed next? To the moon? You know, gold's got quite the backstory. It's always been this shiny allure that's captivated people everywhere for like forever. Way back, people used it in all these fancy ceremonies, and then it turned into cold, hard cash and became the thing everybody wanted to stash away for a rainy day. Fast forward to now, and it's still a big deal. Folks and big companies are chasing after it, thinking it's a safe bet and hoping it'll make them some good money down the line. Gold has been all the rage for ages, way before the ancient Egyptians got into making all those glitzy jewels, big statues, and sacred thingamajigs. People were already big on gold. It's like, since forever, humans just can't get enough of that shiny stuff. It's been used to fancy things up and even for everyday stuff for thousands of years. And you know what? It wasn't long before everyone around the world, from Europe to Asia, Africa, and the Americas, decided that gold was the ultimate bling to show off their wealth. Gold's always been a big deal, right? Throughout history, everyone's been all about it, using it for fancy jewelry and even as money at some point. But, you know, ever since the US dollar took the throne as the top currency around the world, gold's kind of taken a back seat when it comes to everyday finance. Now, it's more like a safety net, the thing people stash away to keep their wealth safe and sound. The gold market from 1981 to 2000. It was quite a wild ride, not in the way thrill seekers would like though. Think of it as one of those periods where gold enthusiasts would be biting their nails, watching the value of their shiny asset sort of trudge through the mud. You see, back in the 80s, gold was coming off its highs from the late 70s. That period was a real bonanza due to all the economic fears and inflation. But come 1981, things started to shift. The 80s and 90s weren't too kind to gold prices, especially as the stock market bull took off and people were looking elsewhere to grow their wealth. This era wasn't exactly the golden age for gold. The price of gold between 2001 to 2010. Back in 2001, the United States was dealing with a lot. Its government debt started to climb, and that made a lot of investors nervous. When the government owes a lot, investors worry about things like inflation or the value of the currency dropping. When the US dollar feels weak, something fascinating happens. Gold, that shiny yellow metal we all love, suddenly becomes the belle of the ball. It's like gold is the financial world's comfort blanket. So in 2001, with the dollar losing its muscle, investors started scooping up gold. The aftermath of 9/11 just adds fuel to the fire. Everyone's thinking, what's next? And the economic uncertainty sends gold prices on a one-way trip to the moon. The price of gold between 2012 to 2015. 2012, it was like someone hit the emergency stop button. Suddenly, all those investors who were watching their gold stash grow year after year started to squirm. The value of their shiny treasure started to dip. And it wasn't just a one-off. This was the beginning of a bit of a slump. Picture this: 3 whole years of back-to-back declines. Each year, the price per ounce was slouching down the chart like it suddenly got tired of climbing. It's like the gold got hit by its own kind of kryptonite. The price of gold from 2016 to the present. Since 2016, things have been looking up for gold overall. You know, it's been one of those assets that a lot of folks turn to when the world gets a bit unpredictable. And let's be honest, there hasn't been a shortage of surprises lately. But here's the interesting part. Even with all that's been going on, in 2018, gold had a bit of a stumble. Prices dipped somewhat. It wasn't a free fall or anything dramatic, just a modest drop. Traders were probably scratching their heads a bit. I mean, after seeing the price climbing. That year was like a hiccup during a feast. However, that didn't last too long and the prices started to pick up again. For more exciting content, don't forget to give it a thumbs up, subscribe to our channel, and hit the notification bell to stay updated. Bank of America thinks the average price of gold will go down to $1923 in 2023. This is because the U.S. Federal Reserve is raising interest rates. China's economy is not growing as fast, and manufacturing around the world is slowing down. This lower prediction for gold prices also means that other valuable metals will probably be cheaper too. On August 4, 2020, amidst all the uncertainty, something historic happened. The price of gold actually soared past the $2,000 mark for an ounce. That's a big deal because, well, that's never happened before. It was a clear sign that investors were really anxious about the state of the world, the pandemic, the economy, you name it. It's interesting because with everyone looking for a safe place to put their money, gold just kind of became the star of the show. And hitting that $2,000 mark was a psychological barrier too. It made headlines and caused quite a bit of buzz, considering that just having gold was like holding on to a piece of stability while everything else was so unpredictable. Gold and silver can both protect your money when the economy or stock market is doing badly, or when prices keep going up over time. Knowing how gold and silver are used differently, how they react to economic changes, and their unique features can help you decide which one might be good for your investments. Some factors to consider when deciding to invest in gold or silver. Silver is now less expensive than gold. Because silver costs less per ounce than gold, it is a more accessible investment for people with limited resources. Smaller investors can buy and hold silver as a physical asset, diversifying their holdings without needing to make the kind of huge capital outlay that gold might. Silver is more volatile than gold. Silver prices often fluctuate more dramatically than gold, sometimes by 2 to 3-fold in a single day. This can be profitable for traders who seek short-term gains. However, for investors aiming for stable growth, the intense volatility complicates risk management within a diversified investment portfolio. Gold has been a more powerful diversifier than silver. Silver is a decent choice for spreading investment risk, showing a mild positive link with stocks, bonds, and commodities. Gold, however, is a superior option for diversification. Traditionally, it doesn't move in tandem with stocks and shares, minimal relation with other key assets. This is largely because, in contrast to silver and other industrial metals, gold's limited industrial demand keeps it stable during economic downturns. Should you invest in gold? Investing in gold involves purchasing physical gold, like bars or coins, which can be part of a diversified portfolio. Those planning for retirement might consider a gold IRA, allowing them to hold actual gold as an investment. However, the suitability of a gold IRA or other physical gold investments depends on one's financial objectives. Pros and cons of investing in gold. Pros: investing in precious metals such as gold, silver, platinum, and palladium can help make your investment mix safer. This is because when the stock market is shaky, gold usually becomes more valuable, which can make up for losses elsewhere. Gold is also good for keeping your money's value when prices go up, since it usually gets more expensive when the dollar gets weaker. People often buy gold when the world is unstable because it keeps its value well. Gold is also easy to turn into cash if needed, though selling actual gold can be more work than selling gold investments like ETFs. Also, you can borrow money using your gold as collateral, which is another way gold can be helpful. Cons: owning gold can be expensive because you have to pay to keep it safe, like in a bank, and insure it. If you sell gold for a profit, you have to pay a special tax that can be up to 28%, which is more than other investments if you've held the gold for more than a year. If you sell it before a year, it's taxed like regular income. Even though gold IRAs save you some taxes like regular IRAs, they still cost money to maintain. Gold doesn't make money over time like stocks or bonds that pay dividends or interest. It only makes money if it's sold for more than it was bought. This means that your investment might not grow as fast as others because gold prices usually go up slowly. The gold price surpassing $2,000 is a significant event in the world of finance. It highlights the importance of safe haven assets and the need for investors to be prepared for a changing economic landscape. If you enjoyed this video, don't forget to give it a thumbs up, subscribe to our channel, and hit the notification bell to stay updated with more exciting content. Thank you for watching, and we'll see you next time.